Hi, it's Dwyer. It's August 2nd, 2025. Always 1776.com, a free site. Also, digitalassetlife.com, a free site. Nothing I say in this video should be construed as investment advice. I want everyone to do their own due diligence. The assumption should be that you trust no one, including me, right? If I mention a stock in this video, there is a strong likelihood that I'm either considering buying the stock or I already own it. Remember, the opinion you should follow should be your own. Just consider this video to be a second opinion from a complete stranger online. Now, folks, we live in a rough world, right? It's tough. Right now, as I speak, that Russia-Ukraine war is still ongoing, right? For some reason, some Russian officials decided to make some tough statements against the United States. In response, Donald Trump has positioned two submarines that are within striking distance of Russia. What I want people to realize is that the press consists of many entrepreneurs. Their market motivation is to sell you advertising. That's how they make money. So they, like TV stations, like YouTube video makers, they are trying to get clicks, right? You need to have your own independent GPS on what stories are important and what stories are not. Let me point out that this move by Donald Trump should be on the front page. It threatens the peace. Why are we antagonizing Russia at all? If Russian officials want to make idiotic statements, why don't we let them? Right? Shouldn't the goal of our government be to keep the peace, to not involve us in foreign entanglements that risk nuclear war, that bring us closer to nuclear war? Right? Putin, the Russian government, as you know, is capable of invading a country. Right? Remember where you were when you first learned that Russia had invaded Ukraine. When you're dealing with actors like that, who can be extremely aggressive, why poke the bear? Right? Sadly, understand, we're hearing more about Shannon Sharp, and I myself made a Shannon Sharp video. We're hearing more about Shannon Sharp than we're hearing about this situation. Well, let's back up a couple of months. You remember the narrative. They would release BLS numbers, Bureau of Labor Statistic numbers, and you were supposed to believe that America was adding jobs, that happy days were here again, that the economy, the stock market, was actually going up because there was an economic basis for it. People were getting employed. Right? Well, folks, a story that should be on the front page, it should certainly be right in the middle of your radar, were the downward revisions. That's the nice, bland sounding term. The downward revisions in the jobs added that were disclosed yesterday. Right, folks? Apparently in May, we added 125,000 fewer jobs than the initial report. 125,000. Think about that. We thought that in May, tens of thousands of people were getting employed who were not. Well, let's compound it. In June, we added 133,000 fewer jobs. Folks, the employment market is broken. You know that if you're a recent college grad, right? Think about it. You went to college, huge opportunity costs, you owe a lot of money, right? That's if you're like most college students, not the wealthy who can pay as they go. How are you supposed to pay back that student loan when you're unemployed or when you're underemployed? What leverage do you have? If you apply for a job, you get a job offer, and you realize that very few people are getting jobs, you're going to have to take that job, even if the salary being offered is not up to par. Well, let's put the May and June revisions, which total 258,000. Again, 258,000 jobs that were reported as having happened which did not exist. Right? These are the unadded jobs, we'll call them. Well, just put it in perspective. Think about how long you've been out of school. Think about how long you've been married. Think about how the world was 10 years ago, 20 years ago, 30 years ago, 40 years ago. Folks, these are the biggest downward revisions since the late 1970s. That's 4.5 decades. That's how singular they are. That's how big they are. And yet, the press is talking about other things, aren't they? Folks, the economy is in shambles. The job market is broken. So, what I'm going to do here is I'm going to put a link to the Shiller PE index. Right? Understand, there are very few things that you can trust. Social commentators have their own agenda. What you should do, politicians certainly have their own agenda. Right? What you should do is you should have some databases, some indexes, some ratios that you trust, whether it's the gold Dow ratio, whatever. For me, and I've mentioned this in the past, I look at the Buffett indicator, which shows that the stock market is very overvalued. I also look at the Shiller PE ratio, which shows that the stock market is very overvalued. I'm more interested in data than I am what any politician has to say. Right? We understand. Trump wants to be popular. He wants public support. He's talking about how good things are. Right? He's trying to tell you that import taxes, tariffs, which you're paying, nobody else is, right? You're the one buying Chinese goods. You're the one buying Canadian goods. You're the one buying Mexican goods. Who's paying for them? You are. Right? He's trying to convince you that tariffs are a good thing. Well, let me just say, the Shiller PE ratio looks at the prior 10 years of inflation-adjusted earnings. Right? You can't just look at dollars because we know fiat currency has been manipulated. We understand that a dollar today is not worth what it once was. So, to figure out whether or not the current stock market is cheap or expensive, and by that I mean, you buy a company really for future profits. You need to find out how much you're paying for those future profits. Right? So just understand, and you'll see it on the chart. Again, I'm going to embed the link in the description of this video. What I want to encourage everyone to do is to save that link because it'll automatically update so you can keep track of the Shiller PE. Right? Just understand that the average, and these are numbers that go back to the 19th century, the average, what they call the mean, the arithmetic mean, is 17.26. In other words, people will pay 17.26 years of earnings for the equivalent of 1 year of earnings. Right? You're paying 17.26 on average for the earnings you're going to receive. Now that's historically. That's going back several generations. Let's talk about the median. Now the median is simply the middle number. Right? So if I'm looking at the numbers 1 to 9, the median would be the number 5. Right? That's the median. As we know, means can be distorted by extremes on the high end or the low end. Right? Spikes that are one-offs. Medians, by contrast, are a little bit more moderated. Right? Because the median is based on the entire range. What's the middle number? Well, between 1 and 9, it's 5. Right? It's not going to get too distorted. If the number 1, or the number 9 has problems still, the middle number is going to be 5. The Shiller PE median is 16.05. It's a little bit less than the mean. So what that's telling you is that people will pay 16 times, a little bit more than 16 times, the earnings for an equity. Well, folks, would it shock you? Just understand, that's the historical norm. If it gets higher than that, right, then just understand the stock market will be viewed as expensive. The earnings that you're paying for, you're getting less of them for unit of payment. Just understand that today, the Shiller PE is at 38. Again, the mean is less than half that, 17.26. The median, the middle number, looking at the historical range, is at 16.05. So just understand, today, if earnings are X, you're paying 38x to get that X level of earnings. Folks, the stock market, by historical standards, is extremely expensive right now. Right, folks? The market is going to adjust over time. Learn from history. The stock market is going to be pretty much flat, as it was from the 1930s all the way to the early 50s. As it was from the late 60s to the early 80s. Right? I'm not kidding when I say I went to the same high school Mamdani went to. Right? A well thought of New York City public high school that requires students to actually take a test to get into. Right? Naval Ravikant went to a sister high school in New York, Stuyvesant. Right? I went to Bronx High School of Science. Back in my day, things have changed a little bit. The other sister school was Brooklyn Tech. Right? So I went to one of New York City's highly thought of high schools. And I'm telling you, I was there for 4 years. And I don't believe there's a single time in the 4 years where anyone at Bronx High School of Science expressed an interest in working on Wall Street. Right? Investment banking wasn't a thing. The idea of making a living trading stocks was not exciting. And that was to people in New York City. Now, the world changed. By the time you get to 87, you had movies like Oliver Stone's Wall Street. Right? Suddenly you had people talking about, capital appreciation, investing in stocks, stock takeovers. Right? I need for people to understand that in American history, we've gone through periods where the stock market has been flat to negative, to the point where, people don't focus on it. It's not viewed as a wealth creation device. In recent years, the idea of private equity, of hedge funds, have taken off. Right, folks? Dare I say it, that's cyclical. Many of these hedge funds aren't making money. I need for folks to understand the stock market right now is overpriced by a wide margin, by historical standards. You need to know that up front. The next time some politician, whether it's the president, whether it's the governor, whether it's the mayor, whether it's some candidate hoping to become the president, governor, or mayor, or senator, right? You need to know before they say their first syllable that whatever they say, the stock market is hopelessly overvalued. Let me tell you the consequences of this. Right, folks? They're profound. Pension plans right now, many of them. State of Illinois, can you hear me? New Jersey, can you hear me? Kentucky, can you hear me? Right, folks? Just do your own research. Lord knows you have AI now on your laptop or desktop. Right? Many of these pension plans are underfunded. There's some backstory, right? Where people say, oh, I paid into the pension. I should get everything I'm promised. Right, folks? I'm just telling you, if you ever go to bankruptcy court, and if you ever sit in a Chapter 7, there's going to be a moment where, some creditor makes a plea to the court, and the court has to politely tell the creditor, the debtor's insolvent. There is no money, right? I can't help you with this argument. You don't qualify for priority under the statutes. Your debt unsecured. Insolvency is what it is. So many of these pension plans are, banking on outsized rates of return, right? Making money in the very stock market that, according to the Shiller index, is overvalued by around 100% today, right? Just understand, these pensions that are relying on, future earnings to pay current beneficiaries, they're insolvent. Many of them are not going to make it. The people running their investment plans, they're not Ray Dalio. They're not Warren Buffett, right? They're not investors, Paul Tudor Jones, who have beaten the market for a long period of time. Let me tell you where the market's going. We know this off the numbers. I don't have to be Einstein, right? I can look at resources like the Buffett indicator and the Shiller PE index and know where the market has been. Just do the simple math and realize that a market that's paying a PE of 38, right, is going to have many disappointed investors, right? Put differently, if you're a tech investor, you know how you're looking at Broadcom, a company making a lot of money, and you're thinking to yourself, and they're involved in AI, and you're thinking to yourself, man, this is expensive, right? You're looking at the PE and you're thinking, wow, high 30s. This is expensive. Am I going to get my money back? And that's on a company making a lot of revenue, taking in a lot of revenue. What happens when the entire market is up around a 38 PE when you strip away inflation? Folks, you have problems. So, you have insolvent pensions. We're going to have to realize that insolvency at some time. I had to stop talking with my friends about their private pensions. Just decided to stop. Because a friend would tell me, hey, my pension's 80% funded. Right? I didn't want to tell them that mathematically meant that 1 in 5 pension beneficiaries weren't going to get paid on average. Right? Your pension should be 100% fully funded. Isn't that the theory behind it? Right? I'm giving you this money for a later day. Instead, the pension's a Ponzi scheme. Right? Understand, there are many pensions in the state of Illinois that aren't even 80% funded. Right? So you have a lot of unrealized losses in the pension market. Let me say this. Real estate is local. I'll agree with that. Right? You have some developers building very vibrant areas that take off. No question about it. But much of the real estate market, much of it, is gonna drop in value. Right? Much of it. It's happening right now in several parts of the country. Folks, You know from the BLS numbers that very few jobs are being added to this economy. You know it's hard to get a job. You know the quality of the jobs has degraded, right? A lot of people are in the gig economy. They're paying for their own gas, being Uber drivers, Lyft drivers, right? This is very different than, you know, having a job where the expenses are covered by some outfit called an employer, right? You understand that we're here talking about pensions, and these days it's a 401k world. And you understand that 401ks have not delivered, right? The value you get from a 401k pales in comparison to traditional pensions. So just ask yourself, if people are losing their jobs, if people are getting paid less in their jobs, right, real wages are dropping, then how are they going to afford homes that over the last few years have been appreciating in value? Right? If you study real estate, and I run a site, housing777.com, visit it please. It's just a site where I post housing stories that interest me, right? I need for folks to just understand that the housing price reflects demographics largely. We're coming out of the baby boom generation. A lot of people who needed a place to live, wanted a driveway, wanted a front lawn, bought a house to raise their family. Right, folks? The demographics have changed. Right? Birth rates in the United States have reached a point where Donald Trump himself has talked about offering incentives for people to have kids. You have some demographic crises around the globe, right? Look at what's happening in Japan. Look at what's happening in China. Folks, they're demographically challenged, right? That's the trend in modern society. As people move from the country where your kid, and this is something Peter Zeihan points out, your kid's actually a worker out in the field, helping the family, to the city where your kids become a liability, right? They're mouths you have to feed. They're not helping on the farm. They're playing video games in the living room. Right? I need for folks to understand that in that world, people are having fewer kids. Right? The demographics don't support the housing market that your parents had. That housing market doesn't exist. The world is different now. So what we're going to have, people in Florida already know the lay of the land. They've seen home prices drop. Understand, when home prices drop, it takes a while for the market to recover. Right? It takes a while for people to go from, I don't want that overhead, housing isn't the investment I thought it was, no more property taxes for me, I'm going to be a renter. If I invest in AI, the right stocks, Broadcom, you know, I can make more than I would make in the housing market. The opportunity costs of investing in a house that's depreciating in value, that's facing bad demographics, is too great. I need to be in Bitcoin, Solana, Ethereum, right? Folks, it takes a while for people to go from that way of thinking to forget the past and to then get back to the idea that housing never drops in value. One of my best friends um, moved to Texas, right? He bought a house for years, for years. He was talking about, how housing's the way to go. It never drops in value and stuff like that. One of the problems with getting older is just like I cannot talk, I just will not talk with friends about their pensions, right? You can't talk with people, particularly not people at our age, right? People who were alive in the 70s and 80s. Uh, you can't talk with them about their personal finances, right? This is different than when you're in high school and college and you can just tell a friend, yeah, I lost my job, and everyone's like, F them, you'll get another job and stuff like that. The conversation is materially different after you turn 40. Materially different, right? So I'm reading where in Texas they're having a real estate crisis. Folks, I got news for you. It's going to get worse. Right? This generation, they understand the action is with tokenized securities and digital assets and stuff like that. You don't want to put $100,000 in real estate and then watch Bitcoin 2x, 3x, 4x, and think to yourself, my goodness, had I put it in Bitcoin, I could have rented this house, lived in the same location, and made a profit. Right? And so just understand, the world is vastly different right now. People are even criticizing passive investing, right? Where, folks said, hey, I can't beat the market. What I'll do is just buy a ETF that's keyed off the S&P 500, right? Folks are knowing that leads to a misallocation of capital. That leads to stock being bought in zombie companies that just happen to be listed on the S&P 500. Right? So you have thinking changing in the investment world, right? You're going to have low profits. You know that by the Shiller PE index, right? You understand that great investors, Jim Rogers, Warren Buffett, have pulled a lot of money out of the stock market, right? They're holding cash. Buffett has a record cash hoard right now. Folks, when the smartest guys in the room start liquidating and holding cash hoards, you should be concerned about what they've taken money out of. Right? We're blessed these days where some great investors, Jim Rogers, who I mentioned, Ray Dalio, who I mentioned, feel a need to give back to the world. So these guys who can get paid big money for interviews and speeches, right? You want to fill a room, you have Ray Dalio there talking on economics and the current state of the market. Instead, what they're doing is they're actually on YouTube telling you what they think about the state of the market for free. Right? It's stunning. Egon von Greyer's another one, right? He's here on YouTube telling you these are very successful investors. These are people who history has proven right. Right? Every time Warren Buffett gives an interview and it's on YouTube, you need to watch it. Right? These are the people who know. These are the elders who've done it, who've had skin in the game, and who have profited. Folks, when Jim Rogers says things are going to end very, very badly. I trust that more than I trust some politician who's trying to get votes. Then I trust some politician who's partly responsible for us being $37 trillion in debt. Right? And folks, understand, the $37 trillion is phony because it's Stanley Druckenmiller, another investment maven, another master. Right? When Stanley Druckenmiller tells you that the $37 trillion doesn't even account for the Social Security debt that we know we have, then you know the numbers are massaged. They're fake numbers. And even the fake numbers are terrible. So please, take a look at the Shiller PE index. The link is going to be in the description of this video. I'm a big believer that everyone needs to do their own research. So when someone starts talking, even if it's the President of the United States, you already know. You already know that the downward revisions on new jobs created are the biggest downward revisions in 4.5 decades. Right? You need to know that so that you can put in context what they have to say. Right? If anyone tells you that this market is doing well, yada, 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 just know it's doing well with a Shiller PE that's more than twice the historical median. Again, the historical median is 16.05. Today's market's at 38. Right? By my math, 16 times 2 is 32. Right, folks? It's hyperinflated. Understand, the Buffett indicator also shows that the market is valued about twice what it should be. If the profits are not there, you're going to have a flat market for several years. Right? Several years. If we unplug the automated investing machine, if the idea of index funds loses favor with the public because people will start to realize, why am I investing in any company automatically, regardless of their cash flow statement, their balance sheet? Right? Shouldn't my investing be individualized? Shouldn't I scrutinize every company? Right? John Bogle may have been a genius at first. What are the long-term consequences of the idea of index investing? Right? If they're negative, if they contribute to $37 trillion deficits, then you are up against it. Right? Understand too, we haven't even gotten into the unrealized losses from derivatives trading. I'll close with this. Jim Rogers recently gave an interview where he said, we're going to have to come up with new words. That's how preposterous the current status quo is. Right? Before they were talking about billions. Now we're talking about trillions in debt. We're going to have to figure out what the next word up is, because that's where we're headed. Be afraid, be very afraid. More importantly, though, be prepared. Research the Buffett indicator. Please research the Shiller PE. Again, the link is in the description of this video. Those are my thoughts. Let me hear yours in the comment section of this YouTube video. Thanks for stopping by.